All right. Coming back to Coffee Cafe, this is where we left off. We just entered in our national, or in this case, the Maine Bank of Nevada, right? Our truck loan bill came in to let us know that we have a bill payment due, right? For our monthly loan payment. So we just entered that in our journal, our ledger, and we completed this transaction. So this is where we left off. So here we have it. We are going to replenish the petty cash fund. So let's take a look here. So if you guys remember way back when, I put the date here, right, on the 23rd of June. We had a party, a grand opening party for the business, right? The owner, Mr. Bob Mason, purchased pizzas, sodas, and etc., right? Here's his receipt for a total of $187.16. We had Irene go purchase a cake for $23.80. And then we had Albert purchase some party supplies for the event. So for a total cost of $71.82. So we are replenishing the petty cash fund. So how do we journalize this?
Business expense and checking.
Good, right? In this case, I'm going to treat all of this because it's a party, it's a business event. So I'm going to consider all of this to be a business expense. Good, right? If you check out all of the expenses, none of them make any sense. So in this case, business expense is the only one that's actually going to make the most sense here, right? We had a party for the business, all right? So what account is my business expense?
6,200.
60.
100.
So we have checking. Okay.
Total will be for 282.78.
Okay. So good. So if we take a calculations here, right? We add up our total amount in the petty cash fund that we have receipts for. So 187.16. Oops. 187.16, right? Plus my $23.80 for the cake, plus $71.82 for the party supplies, gives me a grand total of $282.78. And of course, how do I replenish my petty cash fund?
By writing a check.
By writing a check. Okay, for $282.78. So go to our check register. I'm writing check number 1533. For a total of $282.78. And in this case, I'm going to go ahead and just say, you're just going to write a check to the petty cash fund. Okay. So then, what should my description be?
Mine is petty cash fund, check number 1533.
Good. So then, what do we do next?
Go to business expense in the general ledger.
Okay, so we go to the general ledger. Here we are, business expense. What should your description be?
I just put the check number and replenish petty cash.
Okay. Okay. In this case, I'm going to throw in a little more detail saying this was grand opening party supplies, pizza, soda, and cake. Right? General journal. $22 for how much?
282.78.
Okay, which brings my account balance to
1282.78.
$1282.78. Good. Then we're going to go ahead and go to our checking account.
Check number 1533, replenish petty cash fund. Credit 282.78 should give you 13,142.60.
Excellent. Okay, so that transaction is done. Now, of course, with the receipts, we don't have the receipts. You don't need to journalize and or record any of those receipts in your subsidiary ledger. We're just gonna treat them all as mere business expense and call it a day. All right. The proof is that this is a petty cash transaction. The proof here is that there was receipts in the bottom, and that's what it was for. So in this case, we don't need to update our subsidiary ledger at all. Okay. So then, what happened next?
So we estimate that some people ain't gonna pay based on 5% of account receivable.
Okay.
This one stumped me.
Where can we find our account balance in our accounts receivable?
Two ways to the trial balance we just did, or straight to the ledger?
Perfect. Okay, we'll go straight to the ledger. Okay, so accounts receivable. Here we are. Accounts receivable. What is our account balance right now?
1531.95.
All right, so we need to calculate 5%, right?
1531%. That gives us, if I round it up, it's going to give us $76.60.
$76.60. Okay. And where am I going to journalize that? Or how am I going to journalize that?
Allowance and doubtful accounts.
Okay, which is that a credit or a debit balance?
That is. It's going to be a debit because it's an assets, but I'm lost for why is it going to be a debit?
Okay, so you think it's going to be a debit in the allowance for doubtful accounts.
Oh no, we're going to credit that account and we're going to debit it from the accounts receivable. Or do I have that backwards?
Okay, so if we debit accounts receivable and credit allowance for doubtful accounts, now are we increasing debt that people
We're
owe me?
increasing that we're losing money on the
Okay.
doubtful account,
Okay.
and we're decreasing what they owe us
Hmm.
or what we're going to get in, not
Ne-
what they owe us.
Okay, so I have a question for you then. Do we know exactly who owes us the money?
I don't know why we're going off. That's what I was like. Well, who's not paying? We need to get our sales guy and make some phone calls, or that's
Okay.
because I don't have that information.
All right. So here's another hint for you to be able to figure this part out. If we don't know who owes us the money, right? Or if we don't know who's going to be faulting on their payments, right? And we don't know the exact amount, we had to estimate 5% of accounts receivable. And third thing is, what's today's date?
Oh, the 30th. So we go back to our customers and look up who hasn't paid up.
No. No.
Okay. We don't send Alan over there with a crowbar. Maybe we make sure we get our money.
No.
Oh, okay.
All right. So in this case, the allowance for doubtful accounts, right? You're correct on using that account, but you said you wanted to debit it. So in this case, no, that's wrong. Now, if you remember the difference, right? If you remember chapter 10, when we talked about receivables, right?
Yes.
If we know exactly who and exactly when a person decides to fault on the payment, that's where you're going to take the allowance for doubtful accounts directly out from accounts receivable. In this case, we're reached the end of the given period, right? We don't know who because we're taking a total estimate, right?
Right.
And we don't know when these people are going to fault on their payments. So what conclusion can you get? What am I doing here? What entry do I need to enter here?
doubtful accounts?
Okay, so no, that's when you know who
Oh,
faulted
okay.
on their payment.
Okay. Good hint there. Thanks, Alan.
I'll give you. Okay, I'll give
Yeah,
you.
those were great hints. So not earned income, on unearned revenue.
Okay, so in this case, we've already completed our service. We've already sold them the product.
Okay.
All right. What do you call it when people owe you money and they don't pay?
Bad debt expense.
Bad debt expense. There you go. Okay, so here you use bad debt expense because three things. We don't know who's going to fault on our payment. Okay? In this case, this 5%. Who is this 5%? We don't know. Do we know when out of those 5% who's going to fault on us? No. And thirdly, this is an adjustment that we do at the end of a given period. Because when you do know who and you do know how much they owe you, you're gonna obviously know exactly when. In this case, it's a rough estimate of the overall accounts receivable, so hence we are doing the balance sheet statement. Okay, but in this case, that's irrelevant. You don't really need to know that. That's just extra information. But we're looking at accounts receivable. So therefore, we're going to be fine. We're going to write off that 5% of these people are going to be subject to not pay me, right? And bad debt expense, and what's my credit account going to be?
65000. And we're taking it from our accounts receivable.
No, that's the direct write-off method. No. No, you're not writing it right off of bad debt. I mean, accounts receivable.
Oh, okay. I'm wrapping my hand around this, so walk us through it.
Okay.
Walk me through it.
Allowance for doubtful accounts, I thought.
Exactly.
Oh, okay. All right.
Okay. And now this is why when you start the next period, right? You're going to have a credit balance in your allowance for doubtful accounts because of this reason right here. Because if you do it every single month, you're going to have some kind of account balance in the allowance for doubtful accounts. Now, once again, this is towards the end of the given accounting period, right? But let's say we find out for the next month, Katie decides to not pay us and we go after her and she refuses to not pay us. Then we're going to debit the account for the allowance for doubtful accounts, which then when we do our bad debt, we already have an account balance in there. All right. So here we are. Allowance for doubtful accounts. What account number is that?
11100.
Okay. And we are, oh, whoa. Okay, so we solved for here to be 70, 60. Okay, to be 70, 60. All right. And last but not least, what should be my description?
Getting prepared and not getting paid. I'm sorry.
I guess we could say to write off 5% debt of accounts receivable, right? Because our estimated amount was 5%. 5% of people or your customers in general are subject to not pay, right?
Was that just a standard practice at the end of the month? Like, even if they're going to be late, just write it off?
In this case, this is just general practices, especially if you understand, like, if you potentially allow your customers to owe you money, that's the standard amount of risk that you can assume to take a loss for. No, of course that's for bigger corporations and bigger things. But in this case, I'm going to just apply that standard here too, that our assumption is that you are allowed to write off at least up to 5% of bad debt for all businesses. Because think about it, right? We don't know who people are. Customers, right? They can lose their job at any given moment. They can have some kind of circumstance that affect their financial, standing that can allow them to fault on our payments. We just don't know. We don't know the ins and outs of a customer, right? We only trust them based off of what they put into their credit score, right?